After World War II, a veteran's most important benefit could arrive not as cash, but as a government-backed path into a house. That house could shelter a family, anchor a neighborhood, and decades later become its main source of wealth. The mystery is how a program built to help returning soldiers also created a system where owning an address could matter more than earning a paycheck. The same two-story home could be treated as shelter on the day it was purchased and as a financial asset years later. Its value could rise with the land around it, support a loan, fund a move, or pass to children. But that path was never open in the same way to every American family. The first decision was made in 1944, before the suburbs had spread across the map. Policymakers were preparing for the return of millions of service members. The country had seen what happened after World War I, when veterans faced weak job markets, poor support, and long delays in receiving promised benefits. In 1944, leaders feared a new crisis. Soldiers might come home to limited work, limited college access, and limited housing. The Servicemen's Readjustment Act, known as the GI Bill, was a broad federal response. It offered education support, unemployment assistance, and help with home and farm purchases. The goal was not simply to reward military service. It was to prevent a sudden flood of returning workers from breaking the economy and to give veterans a stable bridge into civilian life. The mortgage feature worked through a powerful change in risk. A lender still issued the loan, but the federal government backed part of it through the Veterans Administration. If an eligible borrower failed to repay, the guarantee reduced the lender's possible loss. That made a long mortgage feel safer to the bank and more reachable for the buyer. The result was a new exchange. Military service could be converted into access to credit. In many cases, veterans could buy with little or no down payment, stretching repayment across decades. A family that could never have saved enough to enter the market could now cross the threshold. The house was not handed over for free, but the hardest barrier had been moved. Levittown showed what happened when mortgage support met industrial-scale building. Starting in 1947, the Levitt Company built thousands of nearly identical homes on former potato fields on Long Island. Standard designs, assembly line methods, and large batches of land lowered construction costs. Federal mortgage backing gave eligible buyers a way to purchase the finished product. This was suburbanization as a financial machine. Builders created homes in places where land was cheaper. Roads connected those homes to city jobs. Mortgage policy connected wages to property. One government guarantee helped turn a distant field into a neighborhood, then helped turn that neighborhood into a store of household wealth. The new suburban landscape carried a promise that went beyond four walls. A newly built home meant space, privacy, a yard, and the feeling that rent would no longer disappear each month. A fixed mortgage payment offered a measure of control in a world where landlords could raise rents or end leases. It also offered a future that renters could not automatically claim. Each payment moved a household closer to owning the property. If prices rose, the owner could gain wealth without earning a second paycheck. The promise was simple: work, pay the mortgage, and let time build something in your name. But eligibility for the GI Bill did not guarantee equal access to the neighborhoods and mortgages it helped create. Local lenders made their own decisions. Appraisers judged areas by racial makeup and location. Developers used restrictive covenants and sales rules to exclude black families and other groups. The law opened a door, while the housing market decided which doors were actually unlocked. The Veterans Administration did not erase those local barriers. In practice, its loan guarantees operated inside a system shaped by segregation, redlining, and unequal appraisal. A veteran could have served the country and still struggle to buy in a growing suburb. Another buyer, entering a favored neighborhood, could receive credit on terms that turned a modest home into a long-term advantage. That difference became visible through money over time. One household made mortgage payments and gradually held an asset that could later support borrowing, a move, or an inheritance. Another household remained a renter, sending payments away without gaining a claim on rising land values. The gap was not created by one bad month. It widened with every year of appreciation. For families shut out of ownership, the loss was larger than a missed purchase. They lost the chance to benefit from the growth of the neighborhood itself. As homes became more valuable, the owners gained options: help with college, a business loan, a safer retirement, or a transfer of wealth to children. Renters faced the same rising costs, but not the same rising asset. A mortgage turned a monthly bill into a claim on an asset. Each payment covered interest, but part also reduced the loan balance. That portion became home equity, the share of the property the household truly owned. At first, the number was small. Over years, it could grow quietly, month by month, without a separate savings account. Then the neighborhood could change the calculation. A new school, a factory, a road, or simply rising demand could lift the value of nearby homes. The owner might sell and carry the difference into a larger house, borrow against the equity, or pass the property to children. The same house had become shelter, collateral, and a family balance sheet. That mechanism reached far beyond individual households. Mortgage-backed demand gave builders a reason to produce homes at scale. Construction crews found work. Suppliers sold lumber, pipes, glass, and wiring. Once families moved in, they needed refrigerators, washing machines, sofas, curtains, lawn tools, and cars to reach jobs beyond the old city centers. The new house was therefore more than a private purchase. It pulled an entire chain of spending behind it. Banks issued loans, builders turned land into subdivisions, factories filled homes with goods, and employers expanded around growing suburbs. The 1944 bill helped connect military service to housing demand, and housing demand to a wider engine of post-war growth. But the engine also created a rule that was rarely written down. Stable employment was paired with a mortgage. The mortgage was paired with a house. The house was treated as the main store of family wealth. Other forms of saving existed, but ownership carried the strongest promise of safety, status, and upward movement. That promise became normal through institutions, not just personal choice. Tax rules favored mortgage interest. Local governments built roads and services around new subdivisions. Employers moved offices outward. Schools, shopping centers, and commuting patterns followed. Home ownership stopped looking like one possible path and began to look like the responsible path. The pattern spread past Levittown. Metropolitan areas pushed outward, replacing open land with rings of homes tied to highways and rail lines. A property's worth increasingly depended on its location, its school district, its travel time to work, and the value of the homes around it. The housing map became a map of opportunity. That link still shapes current inequality. A family that bought early in a growing suburb could gain wealth without starting a company or trading in markets. A family that arrived later faced a higher price for the same kind of home. The unintended consequence was a country where access to a place often determined access to appreciation. The long-term result appeared in public policy as well. Local governments came to rely heavily on property values and property taxes to support schools and services. When neighborhoods gained value, their tax base often strengthened. When families were kept out of those neighborhoods, exclusion could echo through education, jobs, and public investment. For workers and families, the aftermath became practical and immediate. A home bought decades earlier could help pay for college, cover a medical crisis, or fund retirement. A renter facing the same rise in food, transport, and housing costs had no asset to draw upon. The difference followed people into old age, even when both households had worked for years. For younger buyers, the old promise grew harder to reach. Prices rose faster than many paychecks, while rent consumed money that could not become equity. The system still treated a mortgage as the doorway to wealth, but the doorway had moved farther away. What began as a post-war benefit had become a national test of timing, location, and inherited help. The mystery rests in that quiet transformation. A house in the 1940s could be a place to live. By the time its value passed from one generation to the next, it had become a gatekeeper of American wealth.